I have been seeing some cool videos recently on YouTube that have revolved around ranking things. It could be ranking certain stocks, certain types of stocks. It could be ranking sports teams or players or movies, and the list goes on. So in today's video, I think this will be a fun one. I'm going to take 10 REITs and we're going to rank them from best to worst. Many of these other videos use this tier ranking system that doesn't make a whole lot of sense, so I actually created my own, the first and the highest being the must-own section, which is pretty self-explanatory. Stocks of the highest quality that belong in most dividend portfolios. Next, below that, we have the high quality tier. This is another great tier to be in, just a nudge below the best, but still many great stocks or REITs here. Next, we have the like but not love tier. These are solid stocks, but not ones that are high on my list, but still some quality names to go by. And then lastly, we have the prefer not to own. This is not a tier you want to be in necessarily, and not stocks that I necessarily want to own at this very moment. As we go through these REITs, obviously all of these opinions are mine alone as I'm not a financial advisor, so please perform your own due diligence before investing in any of these REITs. Speaking of those REITs, here's a look at the 10 REITs that we're going to look at today on our list. The first being Avalon Bay Communities, Prologis, Simon Property Group, Vici Properties, American Tower, WP Carey, Realty Income, Public Storage, STAG Industrial, and Medical Properties Trust. Hopefully you will enjoy this video, and if you want more like this after watching today's video, if you want more videos with this tier ranking system, then let me know down in the comments section below. And before we begin, do me a huge favor, click that like button down below, subscribe to the channel, and let's get started. Hey everyone, Mark Rusin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And I'd like to take a quick moment to thank today's video sponsor, which is The Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their latest top 10 best stocks to buy right now, just by entering your email completely free. All right, now let's begin with the first REIT on our list, which is Avalon Bay Communities, stock ticker AVB. Avalon Bay is one of the 2 largest apartment REITs in the market today and the 16th largest REIT overall. The company has a market cap of $26 billion, and over the past 12 months, the stock is down 9%, but year to date, it is up 13%. Q1, the company reported nearly 14% core FFO per share growth and same-store rental revenue growth of 9.5%. This week also happens to be REIT Week, which is a REIT conference where numerous REITs provide investor updates. Avalon Bay is one of those, and management gave an operations update, stating that through the first 2 months of Q2, rental revenues are up 6.5%, 80 basis points higher than management's expectations. Occupancy levels ended May at 96.0%. Looking at this chart, you can see the majority of Avalon Bay communities are found on both the West Coast and the East Coast. Avalon Bay pays an annual dividend of $6.60 per share, which equates to a dividend yield of 3.6%. AVB has been slow to raise their dividend over the years, with a low 5-year dividend growth rate of only 2%. The dividend recently got an increase, but prior to that, investors had not seen a dividend hike since 2019. Analysts have a 12-month average price target of $192, implying only 5% upside from current levels. So when it comes to ranking Avalon Bay, we're going to put them in the like but don't love tier. There's nothing against it. This is still a high quality company, one of the 2 largest apartment REITs in the market today. But there's been a lack of dividend growth and really share price appreciation over the past decade, which has me pausing on adding any more to Avalon Bay. The second REIT on our list today is Prologis, stock ticker PLD. Prologis is the largest industrial and warehouse REIT on the market today. The company has a market cap of $117 billion, and over the past 12 months, shares of Prologis are down 2%, but year to date, they've made a comeback, up 12% so far in 2023. One of the reasons I'm so high on Prologis is due to the growth and the growth moving forward within e-commerce. There's numerous ways to play e-commerce. You can buy an e-commerce company like Amazon or Shopify. You could buy the logistics company like UPS or FedEx. And then you could also buy the warehouse, the landlord, which is someone like Prologis. When you are a retailer that sells online, you have a need for inventory. When you have a need for inventory, you have a need for space to put that inventory. And when you need space, you call the likes of Prologis. When it comes to tenants, the largest tenant for Prologis is Amazon, the largest e-commerce company in the world. In 2010, e-commerce sales accounted for only about 10% of retail sales. As of the end of 2022, though, e-commerce sales now account for a quarter of retail sales, and economists believe growth will be about 1% per year over the next 5 years, which is enticing. E-commerce utilizes 3 times more logistics space than brick and mortar, which makes sense because brick and mortar shops can hold inventory at their store and then back up inventory in the warehouse, which isn't needed as much. E-commerce, on the other hand, needs to hold all inventory in a warehouse. Prologis yields a dividend of 2.8%, and unlike Avalon Bay, Prologis has been growing their dividend at an average annual rate of 12.5%. Analysts have a 12-month price target of $145 on the stock, implying 15.5% upside from current levels. When it comes to rating Prologis, what tier we're going to put them in, they are the highest quality industrial REIT on the market, one that will continue to grow. That's why I call Prologis a must-own REIT. The third REIT on our list is Simon Property Group, stock ticker SPG. Simon Property Group is the largest mall landlord in the U.S. today. They have a market cap of $36 billion. Over the past 12 months, shares are flat, and year to date, they are down 7%. If you are a believer that malls are a thing of the past and there's no place for them in today's society, then SPG is probably not a stock for you. However, if you believe there is a space for high-quality malls, ones that SPG owns, it's great for entertainment, it's great for restaurants, and it's also, of course, great for retail and shopping. And if you believe all of this, then SPG is worth a second look because they are the highest quality mall landlord in the US today. Looking at this chart, you can see an NOI breakdown by property type as well as by state. 72% of the company's NOI comes from traditional malls and outlets, and then roughly 43% of NOI comes from the states of Florida, California, and Texas. The REIT also has an international presence as well. The company saw 4% portfolio NOI growth in Q1, which is a key stat to watch when it comes to SPG. They also have a very strong management team, which has built a strong balance sheet and earned the company an A- credit rating to reflect its strength. SPG had to cut their dividend during the pandemic, but they have quickly increased it back and now pay a dividend of $7.40 per share, which equates to a high dividend yield of 6.95%. Analysts have a buy rating on the stock with an average 12-month price target of $130, implying nearly 20% upside from current levels. Now for the tier rating when it comes to SPG, and this is a stock that I've owned for a number of years. I have a cost basis in the low $50 range for SPG, so I have a lot of love for them. But I'm not going to put them on the top tier. We're going to put SPG in the high quality tier, as they are the best of breed in their sector and they have a very strong management team. Before we move on to the next stock, let me tell you about a special promotion going on over at Webull. Right now, if you sign up for a new account and deposit any amount of money, you can deposit $1 in your new account. They will give you up to 24 free stocks for a limited time. Check out the link down in the description below. The fourth REIT on our list is Vici Properties, stock ticker VICI. This is a casino and hospitality REIT and a name that we have discussed on this channel a number of times in the past. Vici currently has a market cap of $32 billion, and over the past 12 months, shares are down just 1.5%, and year to date, Vici shares are flat. Vici is the largest landlord on the Las Vegas Strip, an area that rarely sees a for lease sign, as these operators enter into long-term master leases dating out 20 plus years. Vici went public in 2017 and has quickly been growing and expanding every year. The company currently owns great properties along the Strip such as Caesars Palace, the Venetian, MGM Grand, Park MGM, Mandalay Bay, and many more. Not only has the company and portfolio continued to grow over the years, but so has the dividend, growing at a near 10% clip 4 out of the past 5 years. The dividend is well protected, as even through the pandemic, Vici maintained 100% occupancy rate. Vici currently pays an annual dividend of $1.56 per share, which equates to a dividend yield of 4.9%, and the company has a 75% AFFO payout target ratio. Gambling and casino traffic could come down if we do, in fact, fall into a recession. But remember, when it comes to Vici, they are not the operators, they are the owners, and the operators lease from Vici. So although they're always looking out for their operators and they want their operators to do well, Vici is just focused on collecting that rent check each and every month. Analysts have a 12-month price target for Vici of about $38, implying 18% upside from current levels. And now for the tier rating. Vici is a stock I own. In fact, it is the largest individual REIT that I own in my dividend portfolio, and I have a lot of love for them and really believe in the growth trajectory for the stock. But it's still early for them, so I can't necessarily put them in the must-own category, so we're going to put them a notch below in line with SPG, and we're going to put them in the high-quality tier. The fifth REIT on our list is American Tower Corporation, stock ticker AMT. American Tower is the largest cell tower REIT in the US today, and as 4G and even 5G continue to roll out both here in the US and internationally, there's a great need for more cell towers. American Tower currently has a market cap of $88 billion, and however, over the past year, the stock has been under intense pressure, down 29%. Year to date, AMT shares are down 12%. American Tower is another REIT that enters into long-term leases. They enter into these leases with the telecom giants such as Verizon Communication, AT&T, and T-Mobile, just naming a few. When it comes to cell towers, the company builds the cell towers and then they can lease out 3 different layers. So if they lease out just one layer, it's going to be a little bit lower in terms of profit, but if they're able to get AT&T, T-Mobile, and Verizon all on the same cell tower, it really costs the same to build it, but from there, the margins go through the roof. The company continues to expand internationally, which can be a further growth driver moving forward. American Tower has had a rough go, but at the same time, it has provided a great opportunity for long-term investors. But expansion costs money, and investors are concerned about that as well, at least in the near term. American Tower acquired another cell tower REIT, CoreSite, for $10 billion at the end of 2021 as part of these expansion plans. However, that acquisition is proving a little bit pricey right now. American Tower has a presence in 26 countries and has over 226,000 communication assets. Looking here, you can see management has generated strong growth across key metrics of the business for a number of years. Revenues have a 14.1% CAGR, adjusted EBITDA a 13.4% CAGR, AFFO per share a 12.4% CAGR, and return on invested capital nearly 9% at the end of 2022, even counting for the growth in the communication assets. American Tower is very unique in the fact that they are actually a dividend growth REIT. You don't see that all that often within the REIT sector. AMT currently yields a 3.3% dividend, which is high for them, and over the past 5 years, the dividend has grown at an average annual rate of 17%. In addition, management has increased the dividend for 10 consecutive years and counting. 20 analysts have an average buy rating on the stock with an average 12-month price target of $241, suggesting 27% upside from current levels. AMT is one of the highest quality REITs on the market today, and the demand that we see with 4G and 5G, more data with all of the devices we have, AMT is a great stock to own. That's why when it comes to our tier rating system, I'm going to be placing AMT in the must-own category. The sixth REIT on our list today is WP Carey, stock ticker WPC. WP Carey is another stock that's operating primarily in the industrial and warehouse sector, but they have really transformed themselves over the years. The company currently has a market cap of $15 billion, and over the past 12 months, shares are down 15%. And year to date, just in 2023, WPC shares are down 10%. In terms of the portfolio, WPC has 1,446 net lease properties leased out to nearly 400 tenants. Those properties amount to 176.1 million square feet of space. And as you can see, those properties are located not only here in the US, but internationally as well, with the US accounting for 62% of annual base rent. WPC enters into long-term leases, and they currently have a weighted average lease term of nearly 11 years as of the end of Q1, and many of those leases are linked to inflation. The REIT operates with a very high occupancy rate of 99.2%. Here's a look at the property type diversification based on ABR. 51% of annual base rent comes from the industrial and warehouse property sector, with 17% retail and 17% office, which is the one red flag I have for WPC. However, office used to be a much higher percentage for the REIT until they started moving more towards the industrial and warehouse space. WPC has a high dividend yield of 6.1%, but that also comes with a low 1% 5-year dividend growth rate, which is often the case with higher yielding stocks. Analysts have an average 12-month price target of $83 for shares of WPC, implying 19% upside from current levels, which makes sense given their multiple. The REIT is trading more in line as an office REIT rather than an industrial warehouse REIT, which provides for some great multiple expansion. Given that multiple expansion opportunity, I don't believe that WPC should be trading at a multiple in line with, say, a Prologis, because Prologis is really focused on industrial warehouse, whereas WPC is more diversified. Although it has 51% in the industrial and warehouse sector, it should at least be trading at the likes of a net lease retail REIT, if anything. Given that, I believe it's still a great opportunity for WPC, and in terms of overall quality, I believe WP Carey is a high quality REIT, which is why I'm going to be placing them in the high quality tier. The 7th REIT on our list is Realty Income, stock ticker O. How could I do a REIT video without covering the monthly dividend company? I refer to Realty Income as the gold standard when it comes to REIT. Realty Income currently has a market cap of $40 billion. Over the past 12 months, the stock is down 10%, and year to date, they are down 6%. Even the best have weak periods from time to time. Every once in a while, we see Realty Income shares yielding a 5% dividend yield. And if you go back through history, this has proven to be a great time to add to the stock. And right now, Realty Income shares yield 5.1%. And that dividend is paid out on a monthly basis, hence why they're called the monthly dividend company. In addition, Realty Income is one of only 3 REITs that are on the prestigious Dividend Aristocrats list, meaning they have paid out growing dividend for at least 25 consecutive years. Realty Income partners with high quality tenants, many being investment grade, which speaks to the safety of the company. Here's a look at the company's top 10 tenants based on ABR. Notable names include Dollar General, Walgreens, Wynn, FedEx, CVS, Walmart, Tractor Supply, Lowe's, and Kroger. Looking at the industry diversification, you can see how the company is largely immune to a recession, not completely, but with the top industries being grocery, convenience stores, dollar stores, and drugstores, those all scream recession-proof. Analysts have an average buy rating on the stock, with 3 analysts rating the REIT a strong buy. The analysts have a 12-month average price target of $69, implying 15% upside from current levels. An A-rated credit rating, a strong management team, in-demand properties, and a proven track record, Realty Income has the likes of a must-own stock written all over it. And that's the tier where you will find Realty Income. The 8th REIT on our list is Public Storage, stock ticker PSA. Public Storage is the largest REIT in the self-storage sector, where there is a ton of competition, not just from other REITs, but also private investors as well. The self-storage sector has always been a favorite sector of mine, because in reality, it really is recession-proof, especially here in the US, where Americans seem to not be able to get rid of anything. Public Storage currently has a market cap of $49 billion, and over the past 12 months, shares are down 10%. But year to date, they've eked out a 2% gain thus far. Public Storage has been in operation for 50 years now, and they are the 4th largest REIT by enterprise value. The REIT also sports an A-rated credit rating on its consistent performance and strong balance sheet. Public Storage has 2,877 properties within 40 states, and chances are you have driven by one of those bright orange properties in the past. One of the drivers for the company in recent years has been their transformation to digital. You can literally rent a self-storage unit without any human contact at all, and go to your unit without seeing an employee. Public Storage was the first company to have 100% of their properties have digital access. Given the presence and scale, Public Storage has been able to generate the highest same-store NOI margin, outpacing competitors such as Extra Space and CubeSmart, which is another self-storage REIT I like and own. The company continues to expand and develop to further grow the portfolio, outpacing the competition in terms of square feet by a wide margin. The company pays an annual dividend of $12, which equates to a dividend yield of 4.2%. A solid yield, but where the company has been lacking has been with dividend growth, as Public Storage has only a 5-year dividend growth rate of 2.4%. However, last year investors received a surprise $13.15 special dividend, which was awesome. Analysts are also high on Public Storage, with 5 analysts rating the stock a strong buy and 4 analysts rating the stock a buy, with an average 12-month price target of $342, implying 22% upside from current levels. Public Storage is yet another high-quality REIT with a very strong management team with a proven track record. They're also recession-proof, which is great if you believe that we are going to fall into a recession. But long-term, regardless if we're in a recession or a bull market, I rate Public Storage in the high-quality tier. The 9th REIT on our list today is STAG Industrial, stock ticker STAG. As you could probably guess, STAG Industrial operates within the industrial sector, and they are a direct competitor to the likes of Prologis, a company that we looked at earlier. STAG Industrial currently has a market cap of $6 billion, so much smaller than Prologis, but over the past year, shares are up 7%, and year-to-date in 2023, shares are up 12%. STAG is not at the same level as PLD, but they have very similar qualities and tenants, Amazon also being a top tenant. I like STAG for many of the same reasons that I already mentioned with Prologis, and one of those being the future growth with e-commerce. STAG is much smaller in size, but still growing. As you can see here, when the company went IPO, they had about 93 properties, and today they have 561 properties within 41 states. The REIT has a diverse tenant group with no tenant amounting to more than 2.8% of ABR, and that top tenant is Amazon, and the top 20 tenants account for less than 20% ABR overall, so very diversified there. STAG pays a dividend yield of 4.2% with little to no dividend growth, which is not ideal in that case. However, like Realty Income, STAG does pay out their dividend on a monthly basis, which many retail investors like. Analysts have a 12-month price target of $37 on the stock, implying just 2.5% upside from current levels, which makes sense given the run the stock has already seen here in 2023. So valuations are not all that intriguing at this very moment, but that does not take away from the company as a whole. STAG Industrial is one of those companies similar to Avalon Bay. They're a great company and consistent in nature, but not one that knocks my socks off. Prologis is the premier REIT in the industrial sector. STAG is a great one, but I'm going to put them in our tier rating system. I'm going to put STAG in the like but not love category. This is still a great category to be in, but I'm just not looking to throw STAG into my portfolio right now. The 10th REIT on our list today is Medical Properties Trust, stock ticker MPW. Now I know this is one that you guys are probably really interested in hearing my viewpoint on. And for those of you that are unaware, Medical Properties Trust operates in the healthcare sector. They are a REIT that owns primarily hospital and medical facilities around the US. The company has a market cap of $5 billion, so much smaller in nature than all of the other REITs that we looked at today. But over the past year, shares have been crushed down nearly 50%, and in 2023 alone, shares are down 22%. There have been numerous short reports that have come out for Medical Properties Trust going against the company that revolve around a lack of transparency as well as just a broken business model. And combine all of that together with the fact that 2022 was one of the worst years on record for the hospital sector. Medical Properties Trust has 444 properties leased out to 54 operators within 31 states. The majority of the revenue, about 72%, comes from general acute care hospitals, with 15% coming from behavioral health facilities. MPW does not give you the total exposure by tenant. Instead, you have to do some additional work to add it up, but the REIT has large exposure to some of their top tenants, to which investors see as a red flag, especially when those tenants appear to be struggling or the REIT is loaning them money. Overall, the lack of transparency has been a major red flag for myself, as has the large exposure to just a handful of tenants. Don't get me wrong, hospitals are a necessity and they'll likely be around forever. But if you don't have a good management team and a good game plan, it doesn't matter what assets you have. In terms of the dividend, after the stocks fall from grace, MPW yields a dividend of 13.6%, which is extremely high. Is it sustainable? Not likely, but management believes it is thus far. The stock just has too many red flags for me right now, just too many risks. But if you're looking for a great turnaround story and a little bit higher risk, then maybe MPW is worth a second look. But I do want to say, don't let a high dividend yield fool you. You should never invest based on dividend yield alone. In terms of analysts' expectations, they are hoping for that turnaround story as they have an average 12-month price target of $11.67, implying nearly 30% upside from current levels. So when it comes to our tier rating system, this is a stock that just has too many red flags for me. The management team and the lack of transparency there is just something that I prefer not to own. So that's why you're going to see it in that section right there. I do not prefer to own, and I'm not looking for that turnaround story. I hope it happens for those of you that are invested in the company. But for me, this is a stock that I prefer not to own. So that concludes our list of 10 REITs, going through them from the best rated stocks all the way down to the worst rated stocks. In the comment section below, let me know how you would rate these 10 REITs right now. And if you like this format and want me to do this again, maybe we'll focus on dividend kings or dividend aristocrats or dividend growth stocks, then also let me know down in the comment section below. And make sure you take advantage of that Webull promotion. For a limited time, if you sign up and deposit any amount of money, you could get up to 24 free stocks. Again, I hope you enjoyed the video. Thanks again for watching. I know this one was a little bit longer, but we'll see you in the next one. Take care.